was on the front of every magazine. And
has the UK market
newspapers,
ever had anything that's gone that boogily?
Got taken over, so that was that.
Is that the last one?
well, we've got a nice baking soda company looking to IPO.
Oh, I saw that.
Turkish.
What was it called? What was it called now?
Are we going to call the advent of a new build market based on a new baking soda?
Here come the
God's sake.
IPAs.
What an exciting market. Right, fellas, ready to go?
Born
Ready to go.
Let's get on with it. Hello, folks. Welcome back. Taking stock after the bell, episode 9, and we've blown the budget, and we've got new microphones with me,
Exciting.
James Hughes,
Yeah.
investment manager, and JR, Johnny Raymond's investment manager. Right, fellas, where to start? The Times reckon you can earn £200,000 a year and still struggle. Johnny, you're a man that earns £500,000 a year. What did you think of that?
Yes, it's not true. When it was so the point of the article, and I did read it with interest, was that if you want to go on what does a relatively extravagant lifestyle but not uber rich look like, 2 decent holidays a year, 2 kids in private school / nursery, and
Live in Surrey.
live in Surrey.
£1 million house.
That's it.
Do you know why Surrey has exclusivity on the middle classes? You live in Surrey, though, don't you?
I do. I've no idea because I'm not winning any trophies at the
Middle
moment.
class, middle class. Sorry, I think the 2 things that jump out at me. I think don't know whether this has been from Northern Ireland and our education system being free with private school, 23k a year net income for each child.
Yeah. Well, you've got to earn double that, haven't you, gross? So if you've got 2 kids and you're paying the best part of 50 grand net, you need to earn 100 grand gross.
So that to me, I mean, I don't know what it's like over here necessarily, but that to me feels like the fairly obvious lever to pull. The other one's property prices. So they reckoned in the article that the average property price has risen by almost tenfold since the 1980s, and I'm guessing property in Surrey isn't the average.
No.
Average in that.
No. I mean, if you want a 4-bed house somewhere reasonable, and Surrey's a huge area, but if you want something that's commutable with, that's detached, you're easily looking over £1 million. I mean, the prices have just gone astronomical, and it's all to do with shortage of housing and people wanting a bit more greenery, isn't it?
It seems like a lot of the more historically desirable middle class ways to spend your money have seen mega inflation over the years.
Yeah, 100%. Well, private school fees have gone up by way more than inflation for 20, 30 years. They've done about 6 or 7% a year versus 2 or 3, and that compounds up to be quite a big difference.
I mean, it made the other interesting point of the article was, although income tax rates are actually lower than they were in the 80s, if you take into account national insurance, VAT, freezing of thresholds, etc., actually we're taxed a lot heavier now than we were back then. But it was amazing that they think, well, the article was saying, from the 80s to where we are now, it essentially costs double to live the same lifestyle today on an inflation adjusted basis. I think property prices for me are the big one. I know interest rates are lower, but the big change, and I'm not suggesting it shouldn't have been done, but Thatcher obviously changed regulation to allow you to get a mortgage based on 2 incomes. So it only ever used to be you could get a mortgage on 1 income, and automatic. That's going to double prices quite quickly, isn't it? In a way.
Yeah.
And I'm not for a second suggesting that a household should only be able to get a mortgage based on 1 income, but that's been a major change, and I think there's more pressure on parents now with children trying to live a reasonable lifestyle, that both parents probably have to go to work.
Yeah,
there's less time. There's certainly more pressure on everyone, I think.
Just in the property market point though, I mean, mortgage interest relief, which they refer to in the piece, was canned in 2000.
Yeah.
So in theory, that should have taken a little bit of steam out of property, but property has gone up in a straight line in this country, which we've said before, it's supply dynamics, right? Yeah,
well, you've had 2 major changes, as James alluded to. One, it's now dual income for a mortgage, and interest rates have gone from 15% in 1990 to 5% today via 1% last year. So, if you take those two, those two have been huge factors in the rise of property prices. Now, if you take mortgage rates back up again from 1 to 5, maybe even higher, 6-7%, then to keep your payments roughly similar, as a proportion of your income, the property value has to fall, doesn't it? Because mortgage payments have fallen as a proportion of income, people have been able to buy more expensive houses or bid up prices.
Gear up more,
exactly.
Yeah.
So this is all about interest rates, and lower interest rates allow higher capital values. In a simple way, when you look at a government bond, the higher the interest rate, the lower the price. And when interest rates go up, the price goes down. It's the same for any asset, no matter how you cut and dice it. Now, we've talked ad nauseum about property prices, so let's not go through it too much more in detail. But if interest rates go up from 1 to 5% and even further, there has to be an impact on the property market at some point, because it just doesn't make any sense otherwise.
I mean, of course, there's a third point to the property prices, which is parents and grandparents having the ability to help out our generation or generations, the generation slightly above, whereas I think our parents' generation is quite rare for their parents to have the ability to be able to help out. And obviously, part of that ability is through the rising price of properties, whether parents or grandparents have downsized or accumulated wealth through property and taken it out somehow, but that's obviously fed into it as well. So all in all, it's a more expensive world, Dave.
It is a more expensive world. I think it's probably more expensive. The inflation's come the nice to haves, hasn't it, rather than the necessities, although we're getting major inflation across the board recently, but it feels like decades that's where the inflation's been.
Yeah. I mean, the other thing is, again, the article pointed out pension payments. We're all contributing to our pensions now. Again, if we were working 30 years ago, there were final salary pension schemes, or you didn't have to contribute, or you didn't have pensions. I'm not saying again we should all have pensions. I think the government regulation in terms of having to put a percentage of your portfolio into a pension, a percentage of your earnings into a pension is important.
Yeah.
But that's taking more money away from disposable income and spend.
Well, this is where this all comes back to for me. I just think we all love a moan. And every generation loves to moan about their individual circumstances and feel like they get it harder than their parents, and in reality every generation faces its own challenges. You could just not send your kids to private school, I guess. Is an option. You shared, Husey, this piece from Lion Trust, which I thought was really interesting, because we talked about the debt ceiling. I'm not going to labour the point. Surprise, surprise, it all appears to have been sorted. Because nobody has any interest in seeing the world burn.
Well, we were very confident on it being sorted, weren't we, Dave?
Yeah, on the surface.
There was one of our colleagues that wasn't so confident.
It's something that comes around, and there's a playbook, but interesting sort of contrarian view from Lion Trust.
Yeah, it was. I mean, something I hadn't picked up until they put out their sort of monthly piece, but it was around. Obviously, I think Yellen announced in January that they essentially hit the debt ceiling. So obviously no more debt could be issued, and they had to go to the Senate to be approved, which took until last week. But in the meantime, they had to continue paying government bills. So you have what's the reserve bank account?
The Treasury General Account.
The Treasury General Account, which
it's basically the US government's current account.
Yeah, so it had about $1 trillion in it, and they've essentially run down that account to about 90 billion. So you've essentially had over 900 billion of stimulus pumped into the market in terms of liquidity, and that's just essentially because they couldn't issue any bonds. So the argument was
can't issue any bonds. The money has to go somewhere. Instead of going into US treasuries, it goes into Microsoft and Apple, which in the equity market are about as close as you can get.
Yeah, I mean, people talk about liquidity as this kind of thing that drives markets, and it's quite a nebulous concept. So I sometimes switch off about this. But as James says, if your current account starts the year at $1 trillion and you can't issue debt, because by issuing debt, someone's got to stump up for that debt. So the cash has got to come out of the system to go into US treasuries. Well, if you're not issuing debt, then that cash has got to go somewhere else. Now, it might be that if you don't buy a US Treasury, you might buy a Microsoft bond or an Apple bond. You might buy it off somebody else. Whoever then sells the Apple bond goes and buys a junk bond, and then whoever sells the junk bond goes and buy an equity. So it's like people taking steps up and down the risk curve.
It's a bit like QE. The effect of it is a bit like QE.
It's not dissimilar actually. This is really simplistic, and I'm sure it's not like this. But if you're now going to go back the other way, whereby the Treasury general account is down to what, 50 billion or something. I mean, it was quite low considering the size of how much the US government spends every year. And you now got to get that back to $1 trillion. That means you've now got to issue more bonds. So the person who's got that equity, the person who's now got the Microsoft bond sells the Microsoft bond to buy the US Treasury.
And the risk,
and then the risk goes back the other way.
Well, so this is Josh Brown's thing that I've heard him talk about before, that what kills bull markets and what kills bull markets basically is not necessarily people getting over exuberant, although people will get over exuberant. It's supply, and it's excess supply, and it's loads of IPOs in not the best companies in the world who see their opportunity, and eventually investors just get exhausted. The money there's buyer strike, and that's what causes bull markets. And it's a similar concept. Broadly speaking, the money does have to go somewhere, and if there's fewer treasuries to buy, then maybe you get pushed up the risk curve.
And they started issuing again last week, and for the moment it's not had a knock-on effect to equity markets, but their argument was there's been a decent tailwind for equities based on this quite specific situation, and perhaps that they was basically saying they think the summer is going to be much choppier because of this dynamic, and it was the first time I'm sure there's lots of people that have looked at this or discussed it, but it was the first time it had come across my desk.
It makes instinctive sense to me. It's the sort of thing that actually, if we don't get a choppy summertime, will be forgotten about. But actually, they could look really, really clever, because I think it makes a lot of intuitive sense, maybe coincidental rather than causational, if that's a word, which I don't think it is.
No, agreed.
Japan is back, John.
Japan is back. So the Nikkei is up a huge amount year to date, 25-30% year to date.
Is it?
Yeah. But before we all get excited,
snuck up, hasn't it?
Yeah, but then before we all get excited, in sterling terms, it's only up about 10% because the pound is up against the yen. So let's not get kind of too carried away about it. I checked this morning.
You love getting carried away about Japan.
James gets carried away about everything.
Very excitable.
Drives a Toyota.
James drives a diesel. There was no ESG friendly going on here.
No electric charging points in Surrey. That's the problem.
Japanese equity markets are up the same amount in sterling terms as US equity markets are.
Yeah.
But the chart's amazing. So that's the shorter term chart.
That's short term.
Have you got the longer one?
Oh,
there it is.
What a graveyard.
There it is. I mean,
this makes me feel a bit physically sick.
There have been books written about the bubble in Japan in the late 80s with some extraordinary stories.
Right, take me back to Japan in the late 80s.
The land underneath the palace in Tokyo was worth more than all of California.
Yeah.
I can't remember the name of the palace. The Imperial Palace, is it?
The Emperor's
was worth more than all of California.
Yeah.
Right.
The equity market.
Is that not fair value?
It was then.
Depends if California sinks, I suppose.
And the equity market was 25% of global equities.
Yeah.
At the peak.
Yeah. No,
car company.
Was it
more?
We did this before. We looked at of MSCI World Markets. I think it was higher than the US is today.
It was a lot. It was
a
massive
car
to
companies,
end all bubbles.
tech companies,
exporters and car companies and makers of stuff, TVs, and property.
So and it was on
cameras.
There you go. What could possibly go wrong? And ludicrous valuations, overexcitement, one-way trades,
too much debt, loads of borrowing.
We were talking about this earlier, actually, over Teams. You're absolutely fine, and we'll get back on to the stats around equities versus cash, but you're absolutely fine over most long-term time horizons unless you grossly overpay.
Yeah.
And you grossly overpaid in Japan in 1989.
And it's one of the reasons why in our portfolios we have Japan as a separate segment. It goes back to this time period because it was such a big region in terms of value. It had its own place in benchmarks.
Yeah.
If you look at it now, it's actually quite a small subset of overall global equity markets.
It has. It's slipped back, hasn't it?
Yeah.
I mean, the
Yeah.
obvious. I'm sure there would be people that, people have said over the years that being the biggest geography in the MSCI world is a little bit of a poison chalice, and it's probably going to lead to a period of maybe not as bad underperformance as that. But it doesn't feel to me like the US is quite as overcooked as Japan in the 80s.
Definitely not.
Yeah, no,
Certainly
no
not.
on valuations.
So I think there's a few interesting things. So they've basically gone 30 years of unwinding of this speculative bubble, and Japanese companies are net cash, got very low valuations, been very conservatively managed, and they've been net cash for a reason. What does that mean? It means they've got no debt overall, and in fact they've got more cash on their balance sheet. And if you think about it, they've had deflation for 20 years. So if you've got cash, that's an appreciating asset in real terms. You're better off having cash in a deflationary environment. So if you think about the demographic though, in 1989, if you were 30 in 1989, you'd be 60 odd today, probably in the sort of upper echelons of corporate Japan, with a very vivid memory of starting your career in the late 80s at the height of the bubble. And that, I mean, this comes back a lot to how you feel as an investor, or your formative years having an influence on your behavior for the next 30. If you started your career in 88, 89 and then the whole thing blew up,
you're still underwater from
you're
the
still underwater from that day, but you've battened down the hatches for 30 years because that's your mentality. There's a story about a hedge fund in the US, which is sort of allied to this, that in the late 70s, the 70s were a pretty terrible time for financial assets, and there was a hedge fund in the US that decided in the late 70s or early 80s that the new bull market had started, but the only way that they were going to make money was they had to hire a whole new load of young people aged 25 to 30 who weren't battle scarred by the 70s. Didn't have that scar tissue, because they were the ones who were in a position to take the risk. So corporate Japan has, from a behavioral perspective, hasn't been able to take risks for the last 30 years because they've been deleveraging and trying to unwind this bubble. So, another piece of the bull case is that now you're getting to the point where the people who remember the bubble are beginning to retire and move on, and you've got a new generation, new cohort coming through who may, famous last words, have a slightly more growth mindset and want to close discounts on valuations, want to invest that cash for growth, want to build factories. Japan are very good at AI, robotics, industrialization. They're good at high-tech stuff. So
I think when we started this pod, we were talking quite a lot about reshoring and onshoring back from China, and we did talk about Japan being a beneficiary because there's a huge amount of expertise, know-how, hardworking people. It would make sense to have some relocation to that sort of area. There's obviously other Asian countries that will be net beneficiaries as well, but Japan was certainly something that was focused on at the time.
Other Asian countries are available, but there's some absolute
other than China, yeah.
But there's some fantastic companies in Japan, but I remember when I started, there was a lot of people who would just point blank refuse to have any exposure to the asset class whatsoever. I suppose that's to Johnny's point.
But then, we only talk about it's up 25% local in yen terms year to date. We only talk about this stuff after it's gone on an absolute tear.
Well, so that's everything.
We can be bullish on Japan because it's just gone up, and that's kind of human nature.
Well, to that point, I mean, it's price following sentiment. Example number 3,670.
We do like that.
We've got some charts on sentiment. This one, Johnny.
The national
hedge fund, isn't it?
No, this is long only investment managers. The top pane here, long only investment managers exposure to equities. So when the blue line is higher, that means that they've got more exposure to equities, and when the line is lower, they are more underweight equities. And you can see that recently that line has gone up materially. And the bottom pane on the chart is the US equity market, the S&P 500. And funnily enough, when the market goes up, investment managers' exposure goes up as well. Now, I'm not saying that one causes the other, but as you say, Dave, sentiment follows price. And when the price goes up, a lot of fund managers feel as though they have to be more invested and more bullish. And this is it.
I spend a lot of time thinking about which causes the other. It's probably price, isn't it? I think there's probably a lot of people who feel so. Probably the classic example, the recent example is probably Nvidia. If you're a long only manager, it's just gone into the top 5 companies in your index. If you don't have any,
you can't not own it now.
You might have a little nibble, keep it outside your top 10, maybe.
I mean, I mean, hedge fund exposure. It's amazing the 180-degree turn they've done since the beginning of the year in terms of being massively long value going in. And within a few months, it's all completely swung around. They're massively long growth again.
I know we talked about it before, but this is why you don't listen to hedge fund managers on CNBC.
Totally.
Because they won't be being disingenuous necessarily, but they'll come on Tuesday, say one thing, and on Wednesday they'll change their mind and they won't phone up CNBC
No.
to say, oh, by the way, I've completely repositioned my portfolio. So it's just, it's a mugs game, but that's example one.
Yeah, but also they have the ability to change things on a very short-term basis, whereas we are long-term investors and are very proud of the fact we are in it. It works with our client base to run money in that way, and performance is steady over that time period. If you're a hedge fund manager, everything or a lot of it's geared or leveraged, and it's unfortunately you're only as good as your last quarter. And they're paid to make aggressive bets. It's just a completely different side to the industry. I also, again, we've talked about this before, but when you're a hedge fund manager, I think clients don't get to see all the individual positions. They can cut and change things whenever you want, whereas we do have an element of, the valuations we produce have every single line of investment on. There is.
You're very defensive of what's in your valuations, aren't you?
Transparent, yeah. I mean,
transparency is everything.
Transparency is everything.
Can you imagine if you were a client of a hedge fund and you had full transparency into what they were doing underneath the bonnet? It would be petrifying.
Yes, it would.
Have you seen some of the total costs on these sort of hedge fund-like strategies that are within portfolios in MiFID II world?
Yes,
they're just absolutely terrifying.
Turnovers, hundreds and hundreds of percentage points.
Yeah,
mad.
Long short funds, just the turnover means that you've got absolutely eye-watering, which is fine when it's working. Less so when it's not.
It's the old 2 and 20, isn't it? A lot of them still charge that way.
Yeah. Sentiment number 2. This is a chart that we spend a bunch of time, or we check in with fairly regularly. Sentiment indicator from our friends at Citi. Sean, people still feel a bit nervous.
This has been a bit of a surprise. So the Levkovich index, as is now known, formerly the Panic Euphoria index, is an objective way of showing market participants' sentiment levels. So when the blue line is higher, markets are participants are deemed more euphoric, and these are professional investors mainly. And when the line is lower, then investors are deemed to be panicked. And at the moment, the line is in panic territory, pretty much, or there or thereabouts, which, when the market goes down, then that's sort of to be expected. And you've got periods where the equity market sold off before and you've got some panic, but you've also got 2 big points of euphoria here, 99, 2000 and 2020, 2021 post-pandemic. And
I mean, this is almost the reverse to the previous slide we showed in terms of active long-only managers positioning versus
which is why it's a bit of a surprise. But
it is, and we get quite excited when this index is in panic territory because
it's a really good contra indicator.
It is, and then you look and the DAX is at all-time highs and the S&P's 25% off its lows, and
there is a disconnect between what people say and how they feel and how they invest.
That's true.
I mean, we'll come on to it. I know, leadership has been very narrow.
Because
maybe that's part of it.
But we've talked about it before, and we are, God help us all, professional investors. We might feel negative.
Speak for yourself.
No, we might feel negative, and this is a really, really important point. We might feel negative. We might be concerned. We might be seeing all the same headlines that clients are seeing, but we might not necessarily be doing huge amounts in portfolios, going 20% to cash, because that historically has not been a good idea.
I mean, history tells us, and our training has taught us that when markets are fearful, that's when we should start putting money to work and
it's hard though.
Yeah, it is hard, and keep our conviction. But that's why this is really interesting. That we are in panic territory still.
Yeah, I just think that
So equities,
playing that
equities
game
onto
is
the-
playing
onto
that
the
game is
moon.
so difficult because stock markets quite a lot of the time exist to inflict maximum pain on you.
Yeah,
Yeah.
and
And if
I
you can get through that, then you'll be
Mm.
absolutely fine. But they've
I
a
was
habit of
thinking
kicking
these,
you when you're down.
yeah, I always think these sentiment indicators are really good pieces of the jigsaw and
Yeah.
pieces of the mosaic, and you need to use a few of them.
Mm.
But when when everyone is panicked, whether that's the investment, the previous one, or the Levkovich index, or the retail, the AAII retail,
Yeah.
which we've used before, when they're all pointing, saying that everyone's panicked, that's probably a time to
It's a
get
bit messy.
interested.
It's a bit messy. at
So
the
it's a
minute.
really good contra indicator, but it's not the indicator. It's definitely something to use alongside, valuation, fundamentals,
Mm.
bit of macro, if that's what you're into.
I think short term sentiment is great,
Yeah.
but none of us really invest in the short term. So it can be a decent indicator of how what returns might be like
Mm.
over 6 to 12 months. But vast majority of our clients have much longer investment time horizons.
Yeah.
So it's helpful in the short term, but we don't really does it find loads of implications in portfolios? Well, no,
Mm.
not necessarily.
No.
I mean, the nice thing is, equities are not overbought based on this. Valuations are still very reasonable. It's a good starting point, isn't it?
Definitely.
To give you an idea of how far sentiment has swung in both directions,
This is
this is
incredible.
momentum. This is the momentum ETF, isn't it, or a momentum strategy? So this is from Wells Fargo. So at the moment, the big move here is that at the moment, this strategy has got 2.9% in technology and is about to buy another rebalance 18% of its exposure into technology. This rebalances every 6 months.
6 months.
So 6 months ago, you couldn't give tech away. 6 months later, you've got to buy back a fifth year portfolio into technology. So maybe let's just explain first of all how the strategy works. It's buying stuff that's working, right? It's buying stuff that's going up.
Yeah, momentum as a strategy has some decent academic theoretical underpinnings, i.e. prices trend over a medium time horizon. And it might sound a bit flippant, but prices tend to trend until they stop trending. So if we think about 2020, 2021, then the Netflixes and the Facebooks and the Amazons were working really well, and they were all in uptrends. So a momentum strategy like that would have been heavily overweight those sort of strategies and heavily underweight energy, materials, whatever wasn't working at the time. And then of course 2022 came along and the whole thing flipped over. Facebook and Amazon and Netflix all fell 50% plus. Chevron and Exxon went to the races because the oil price went up. So a momentum strategy like this one would have flipped its exposure into energy and out of tech.
Yeah.
And lo and behold, this year the thing's reversed pretty much entirely again. So these momentum strategies are trying to catch up. So it's not been, when you get short-term reversals and you get trends that don't last very long, strategies like this don't do particularly well because they're always behind the curve.
Yeah.
But if you get trends that tend to work for a long period of time, and tech from 2010 onwards would have been a really good example of a trend that was in place. I'm guessing that this sort of strategy would have had a lot of tech through that 10-year period.
Yeah, you didn't really get a mean reversion during that.
No.
From about
You would have
14, it was
outperformed.
one-way trade,
Yeah.
basically.
So,
But with
you
this
know,
flip-flopping of the market at the
Flip-flopping the
moment,
market is
with
horrible.
different
Yeah.
stocks leading it,
momentum feels to me like quite uncomfortable as a strategy. It just doesn't seem to make any sense. Well, if something's gone up, why is it going to keep going up? I'm always sort of one for when something goes down, I naturally get interested, and that's one of my own kind of behavioural biases, and I'm aware of it, psychological biases. But the evidence is pretty overwhelming that momentum works a lot of the time on certain time
Probably
horizons.
works because it's completely counterintuitive.
Yeah,
It's
well,
buy
yeah,
high and sell low,
and
right?
and it's human nature. It's a human nature thing, right? So the momentum works because humans are not rational agents, as the economics textbooks say.
Okay.
But it's interesting.
how much impact is this rebalancing going to have? Presumably very little.
This is, again,
They're
that's
not
another thing
massive.
that people say, like back to the tortoise thing.
Mm.
People say, people hang it out there as some kind of
Yeah.
post-facto rationalization for
yeah.
tech
Totally.
doing well. Who knows? I mean, I don't know, but
I don't think
it's an interesting
masses
gauge of
of
where
capital.
sentiment
Yeah, it is.
has come from in the last 6 months, because
Yep.
6 months can sometimes feel like a long time.
Yeah.
So, last couple of things. Doom and Gloomster's new topic du jour is the lack of market breadth and strength in the market. So, Hughesy, this is the performance of the top 7 stocks, isn't it, in the S&P?
It is, and the performance of the other 493. So
400 lovely maths. That checks out. So the large 7 portfolio is obviously smoking since the beginning of the year. The remainder of the market, people would say, well, if you've only got a market that's being held up by 7 mega cap names, then we're doomed.
I mean, there's two schools of thought, aren't there? There's the ones that, you know, as you say we're doomed because market breadth has been so narrow. But then on the other hand, there's a lot of talk of the rest of the market catching up, and actually we've seen, you know, the last few days we've seen a bit of that as well. I mean, the Russell 2000 has had a pretty good performance since mid last week.
Yeah, had a good week last week.
So there is a bit more. This week it's broadening out slightly, but of course it's got a long way to go to catch up what Nvidia and the like have done.
I heard I think I heard on a pod I was listening to earlier this week that the gap between the I think it's 12 or 6 months performance between the market cap weighted and the equal weighted S&P is at all time wide.
Yeah,
width.
I mean, one thing which is very obvious is this sort of environment is very difficult for active managers because no one is as concentrated as this, and you know, you could never guess the names that are going to do that. But you know, running a more balanced portfolio, you know, looking at what the other 493 stocks have done, you'd be probably very small numbers up versus what the S&P has done. So
the
Apple is at an all-time high current valuation, $2.9 trillion.
Crikey.
It's done. So you would have talked about it the other week, I suspect.
It's $2.9 trillion more or less than the value of the land underneath the Japanese Emperor's Palace.
Get back to you on that, Dave.
So it's more than that market cap is obviously more than the FTSE 100. We discussed that before, but Apple has half the sales that the FTSE 100 has.
Half the sales. Well, it's probably come back to that point we made a couple of weeks ago. Miners versus Meta, doesn't it? You know?
Yeah.
It sort of feels like dreams are getting a bit pricier again.
It does, but
not that Apple's a dream company.
You look at the long-term average in terms of PE on the S&P 500, and even with these big 7 stocks, it's not unreasonable. And actually, if you take the 7 stocks out, we were looking at it a minute ago.
Looks cheap.
Yeah, it does. I mean, what have you got the numbers?
Yeah, so the S&P is on 18.5 times, 19 times this year or next 12 months earnings, which is not way out of line. The 15-year average is like 16. Yeah. So it's expensive relative to its long-term average, but not egregiously so. And again, if you strip out those top 7, and those top 7 include Tesla and Amazon, and Nvidia, which have all got pretty high multiples for various reasons, then the rest of the S&P, the 493, as we've now christened it, is probably on 15 times earnings, which is probably cheaper than this 30-year average. So it's do you think this is going to continue? I don't know.
Well, just before we get off breadth, I mean, was it you said, Johnny, breadth is something the bears say to make themselves sound clever. Actually, the data is actually would suggest it's intuitive that a market which is being held up by the 7 biggest companies is not a healthy market, but that's actually not what the data tells you. So this is the numbers from BMO via FactSet, I think, via Michael Batnick's blog, which I picked it up from. Following periods of mega cap outperformance versus the rest of the market, so the top 5 stocks outperforming the rest of the market, you have had on average a 6.7% gain in the 6 months following those periods, and 12 months out 22.2% average annual gain. So that suggests that, to your point, James, the market tends to catch up rather than the bigger names falling. Counterintuitive, but
I saw the other. Obviously, S&P's about 25% higher than its lows. I saw something earlier, which was when there's a return of over 20% from its lows, in the following year, I don't think the S&P has ever closed lower than the point before, or the point at it when it reached the plus 20%. So there are some data points out there now which are some technicals which are becoming.
So and the other one is for maths lovers out there is the Fibonacci retracement levels. So if you get your Fibonacci numbers
studying,
out,
isn't it?
I can feel the palpable excitement.
So the S&P has
steaming off Johnny
reclaimed.
Raymond.
So the S&P has reclaimed 61.8% of the fall, which is a very important Fibonacci retracement level. These are just lines on a page, numbers. So don't shoot the messenger here. But again, once that threshold has been reached when recovering from a bottom, a new low has not been seen. Yeah. So again, it's not to say it will never happen, because stuff happens that has never happened, and the sample size is quite small. But based on history and what we've seen before, it seems unlikely that the US market is going to see those those lows that we saw in October last year.
You had me at Fibonacci. I mean, how much of a heartbreaker would this be if you did go back to the October lows?
Well, it would be a kick in the teeth for lots of people.
Be prepared for it. May not happen, but be prepared for it mentally.
Be prepared for everything.
I mean, yeah.
History never repeats itself.
No,
but it does rhyme.
It does rhyme often, and there are things that we can look at.
Right. Final thing. Slightly common question that we have been getting. I get why I would invest into stocks and take risk whenever interest rates are zero, but interest rates are no longer zero. I quite like the sound of 4.5%-5% taking zero risk. We all know that having cash in the bank is not zero risk. It's just a different kind of risk. But I wrote something to try and act as a little bit of a rebuttal to that and remind ourselves why we invest in equities at all. During periods when interest rates are a little bit higher. So what we did was we went back and looked at the 5-year rolling returns for the global stock market, MSCI World, in sterling terms, and compared it to basically cash, what cash gave you per annum over that 5-year period. And what we can see here is that from 1985 to the current day, you would have been better off investing in equities over those rolling 5-year periods 74.2% of the time. So basically, any time the blue line there is above the x-axis, the zero, you would have been better off in stocks versus cash over the previous 5 years. Over 10 years, the probability is slightly better. You would have done better in equities versus cash 85.5% of the time. And finally, over 15-year periods, probably unsurprisingly, you would have been done better even again. Probability of stocks outperforming cash over rolling 15-year periods was 91.3%. A couple of additional things to say there. One, if you exclude dividends, this doesn't look anywhere near as good for equities. So dividends are really, really important to total returns. 2, interest rates during this period are above where they are currently. We're above where they are currently for 2/3 the data set. And 3, interest rates in the 80s were about 10%. So it's not just been a period of ultra low interest rates.
I mean, it makes perfect sense, because if I'm running a business and I'm having to borrow at 5%, I need my margin to be well above that level.
Yeah.
Taking into account staff costs, material costs, etc., etc. So prices go up, and your returns, ultimately, your earnings per share, higher than that cash return. It's just, otherwise you wouldn't run a business. It makes, if you think about
sense.
it,
the business has to do better than cash, otherwise no one will start a business.
Think about it that simplistically, which I think we need to in this instance, in a way. Otherwise, there'd be no entrepreneurship. There'd be no opportunity to go for if you couldn't ever do better than cash. So,
no.
That's why I think.
I mean, the other side, as an investor as well, you should be rewarded with some. I mean, the equity risk premium a thing.
Yep.
I mean, logically, it should be. If you are putting capital to work by staking capital for businesses, it should do a little bit better than having it left in the bank. Economically, I mean, that logically should be the case.
Totally.
Pretty other final thing to say on this as well. It's asymmetric in a way. So when equities outperform cash per year over the 15-year rolling periods, they do so on average by 4.7%, when they underperform it's by 0.8%. So actually, if you're going to underperform cash, you tend to historically have done so by less than if you beat it, and when you beat it, you tend to wallop it.
Yeah, I mean, this is great. This is brilliant.
It's quite
work.
amazing data.
And and it's interesting if you pick the points in time when cash has outperformed equities, which is the minority of the periods, and as you say, tends to underperform by less than you outperform the other way around. They are your investment starting point. And all those examples was during a period of very high equity market valuations. So if you invested in 99, 2000, when valuations were super high, if you invested in Japan in 1989, if you invested in the US in 1929, if you invest at moments in time when valuations on equities are very, very high, as the data shows, you are more likely to underperform cash over the ensuing 5, 10, 15 years because you're starting from too high a point in time. Yeah. So, I love this. I think this is brilliant, and it one of our good friends has got a very simple investment strategy of just lob it in and forget about it. And unless
the market is egregiously overvalued,
exactly.
Unless you overpay egregiously initially, you will be
You'll
fine.
be fine. But you've got to
have a sufficient time.
You've got to put up with the nonsense that goes, which is sentiment indices,
recession,
US government shutdown, debt ceiling, Greek debt crisis.
3 lads in meeting room 5. Talking how miserable they are. Yeah. Cynicism
in general. So, if and we've had conversations about it in the last few weeks, because today the UK, I know your chart here, the UK 1-year gilt, your chart shows it at 4.94. You only produced this chart this morning, and 6 hours later, the UK 1-year gilt is now 5.05. So you can now get more than 5% on a 1-year UK government bond.
Yeah. So that hurdle rate's getting higher. I think the reason the hurdle rate I think feels so high is because people have become accustomed to getting 0 on cash for so long. So going from 0 to 5 feels a lot more of a move than from 5 to 10.
It's a huge move. But the point still stands, based on the data, based on valuations, based on history, equities today have got a higher probability odds of beating cash over 5, 10 and 15 years. So if you've got cash and you want to return and you don't want to touch it for 5 years, then you are more than likely better off by far investing in equities and not holding it in cash.
And if they do,
despite yields being at 5%,
your relative
outperformance is
going to
higher.
be a lot better.
Yeah. So it is, in a nutshell, the lob it in strategy.
Lob it in.
Lob it in. That's what you've got to title it. Lob it in.
We always come up with a title at the end. Thanks very much, guys. That was brilliant.
That's good.
For farming. Thank you very much for joining us again. We'll be back next week. I think it's next week.
We'll star guest next week.
Well, it's episode number 10, so we've got a star guest coming in. In the meantime, if you've got any questions, let me know at david.henry@cultureachieveit.com. Otherwise, we will see you next week. Thanks very much.
Thanks.
Bye.